Hi traders, Gavin McMaster here from Options Trading IQ, doing a video collaboration with Bar Chart. And today we're looking at bull put spreads. So let's get stuck into it. Just before we do that, a quick reminder that everything discussed is for educational purposes only, is general in nature and does not take into account your personal circumstances. So bull put spreads are a common trade for option traders with a bullish bias who are seeking to generate income. Unlike naked puts, a bull put spread is a risk-defined strategy, so you always know the worst case scenario. In today's video, I'll show you how to set up a bull put spread and how to manage the trade. To open a bull put spread, traders would sell an out-of-the-money put, then buy a further out-of-the-money put. The maximum profit is equal to the premium received. The maximum loss is the difference between the strike prices less the premium received. Bull put spreads are fantastic on stocks that are in a bullish trend and have pulled back to a major moving average like the 21, 50 or 200-day moving average. And you can see a good example here on Apple. Bull put spreads benefit from time decay, otherwise known as positive theta, which means that with all else being equal, the position will slowly gain in value each day due to the passage of time. Some of you might be familiar with this option time decay chart, where the time decay starts to get more intense the closer we get to expiration. Here is an example of a bull put spread on Apple stock. So the date was April the 12th. Trade was selling one Apple May 19th 145 put at $1.45 and buying one Apple May 19th 140 put for 90 cents. The net premium received is 55 cents or $55, and the maximum risk is $445. So that's about an 11% return potential on this trade. And you can see the thick blue line there is our expiration graph, expiration date payoff graph, and the curved line is what's known as a T+0 line, which basically tells us how does the trade look as of today. So you can see if the stock goes down a little bit early in the trade, we could lose some money, but as long as it stays above 145 at expiration, the put spread will expire worthless and achieve the full profit. With a typical bull put spread, the risk is higher than the potential reward, which is not ideal. What separates pro traders from novices is their ability to manage the trade. Let's look at some ways to manage a bull put spread trade. Firstly, if the trade has achieved a profit equal to 50% of the premium received, that can be a great time to take profits and move on to the next opportunity. This is particularly true if the profit comes in the first half of the trade. One rule for managing losing trades is not letting the loss get bigger than 1.5 to 2 times premium received. And ideally, you should never let a bull put spread go to the maximum loss. So you always want to cap that loss at 1.5 to 2 times premium. This is a good rule for a 15 delta bull put spread, but would need to be tweaked slightly for more aggressive spread placement. So that previous one we looked at with Apple, that was about a 15 delta spread, and that just means that we're placing the short strike at the 15 delta. Another rule to consider is rolling a losing trade out in time to the next expiration. The next expiration could be a weekly or a monthly option. The main thing to remember is to only roll for a credit. Rolling out in time means tying up precious capital for another week or even a month. So it's essential to receive a credit for the extra risk being taken for having to be in the trade for a bit longer. Bar Chart has some great bull put spread screeners on the website. Here we've got an example from today. If we look at that first example on Upstart, the stock's trading at 27.65, and this spread would be looking at selling the June options monthly expiry, selling the 27.50 put and buying the 25 strike put. That spread could be sold for about $1.13. So anyone selling that spread would receive $113 in premium and that's theirs to keep. And then it's just a question of managing the trade from there. The maximum loss, you can see there $1.37. So that's the difference between the strike prices, which is $2.50, less the premium of $1.13, gives us our $1.37 maximum loss, or $137 in total. So that's got about an 82% profit potential and a probability of about 56.4%. If we look at another example, the fourth line there on Tesla, the stock's trading at 188.87. This trade would be going out to the July expiration, selling the 185 puts and buying the 180 puts, so 5 points wide. That spread would receive about $2 in premium, or $200, which would make our max risk or max loss $3 or $300. So that's about a 66% return potential and a 56% probability of success. If we go over to barchart.com, we can run a bull put spread screener. If we go to options and bull put credit spreads, we can see here's our screener and our results, getting some good highly liquid tickers here, which is good. So some really good ideas. We can filter by max profit or by percentage probability, however we want to do it. So definitely a good way to find some trade ideas there. Another thing that you might want to consider is just adjusting some of the filters. These are pretty good, the general filters, so they're fine as they are. Something I might like to do occasionally is include ETFs. I typically don't want to do really short-term spreads, so sometimes if we're getting close to that monthly expiration, we might get some results that are only 1 or 2 days to expiration. That's a bit too short-term for me, so I might go 15 to 60 days. I might include weekly expirations. That's a good thing to do as well. And we've got some good volume and open interest filters here. So this will filter out any low float stocks, any stocks that don't trade a high volume of options, which can be a bit tricky when we're doing spread trades, because with a wide bid-ask spread, it can mean it's hard to get filled at a good price. But we could always drop this down a little bit. If we want to see some more results, we could just drop these down by half. And this one here and this one, and that will give us a few more results in the screener. So that's something that could be considered. The other thing is this is a good range, 0 to -10. So that's how far out of the money the bull put spread is. Wouldn't really recommend going out too much further than that, but some people might like to go really deep out of the money. They might want to look at, anything that's, -10 to -20%, really far out of the money. That's something that you could consider looking at as well. We'll just see how these results look. I'm not sure if we'll get much here or anything of good value, but yeah, getting a lot on SPY now. But these are a bit low value with only selling that spread for 5 cents. So we'll just filter back by max profit again. And now we're seeing some more results than we had before on some stocks that have not quite as good a volume, but still some pretty active names there. GME, PacWest, Roku, some of these ones that weren't showing up before, Twilio. So that's certainly something that you could look to do as well. The other thing I like to do when I'm looking at this screener is if I just right click and open in a new tab, I can then drill into the actual stock. And, I always like to look at the bar chart technical opinion. I like this little chart preview that we have here. And I like to look for IV percentile and IV rank as well. When we're trading bull put spreads, we're selling options. So typically we want to be looking for a stock with a high IV percentile or IV rank. 43% isn't too bad. Volatility generally in the market is pretty low at the moment. So that's actually a pretty high volatility. The other thing that's really good to do is just check the earnings date as well, because sometimes we don't want to be trading options right before earnings because there could be a big move in the underlying. So nice little snapshot of information that we can get here really quickly, and that can help us with our decision making in terms of whether we want to take that bull put spread trade or not. In conclusion, bull put spreads are a risk-defined trade with a bullish directional bias. The maximum profit is equal to the premium received. The maximum loss is the difference between the strike prices less the premium received. Trade management is an important skill when trading bull put spreads. And as always, it's important to remember that trading always carries risks, and traders should always do their own due diligence before making any trades. I hope you enjoyed this video on bull put spreads. If you've got any questions, please leave a comment below. Also, don't forget to try Bar Chart Excel. You can get a free 14-day trial at barchart.com/excel. And be sure to check out the screeners on barchart.com. Go and have a look, run some of those bull put spread screeners. If you've got any questions, drop a comment below, and we'll be happy to help out. Take care and best of luck with your trading.